Ma'am, you know why I'm so bullish on Titan even today? The price has gone from 40 to 4,900. Nobody has come and told me once that we must buy Titan. So, what is expensive and what is not expensive? I think as long as Titan has 20-25% growth and his return on equity exceeds 30-35% and operational cash flows is equal to profits, I think PE will survive.
Rakesh Jhunjhunwala talks about what are the 3 key metrics that he looks for when picking a great stock. And secondly, he talks about his philosophy on how he decides whether a stock is overvalued or not. He looks for companies that consistently generate very high return on equity, generally above 30%, and the companies that display a very high sales growth rate over 20%. And finally, companies that generate huge cash flows. Each of the stocks that he owned displayed these characteristics over a very long time. Secondly, just because a stock went up 10, 20 or even 100 times does not mean that the stock is overvalued. If the fundamentals of the business are strong and there is more potential for the business to multiply, he continues to own the stocks for a very long term. With that said, let us listen to his next lesson.
See, most people say they are investing, but actually their mind is of a trader. That they want to create, you can create unimaginable return in trading. I don't say that, but in trading I can tell you one thing. If 10 lakh trade, 9,99,990 say they made money. And 9,99,950 are. That is a real
lying.
Are lying.
Rakesh Jhunjhunwala distinguishes between a trader and an investor. While most people claim to be investor, but in reality they are stock traders who buy and sell stocks only for the short term. And as he mentions, 99.9% of short-term traders either lose money or make less money than the index in the market. The expectations that most people have about the stock market are unrealistic, and people assume that they will make a lot of money in a very short time in the stock market. These unrealistic expectations lead people to treat the stock market as a gambling machine, which eventually causes them to lose money. With that said, let us listen to his next advice.
That it's not important that you're right or wrong in trading. It's more important how much you lose when you're wrong and how much you make when you are right.
Rakesh Jhunjhunwala talks about asymmetric gains, and this does not just apply to short-term traders but even to long-term investors. Imagine if you invest $100 in stock A, stock B and stock C. Now, if stock B and stock C go to zero, you will lose $200. But at the same time, if stock A multiplies 5 times, then you will gain $500. So overall, you make a profit of $300, despite losing money on 2 stocks. So in summary, if you win big, then your wins will cover your losses, and you will turn out to be profitable. With that said, let us listen to his next lesson.
How do you choose a stock? So see, the basic thing I will tell you is when you invest in a stock, think of the business model of that company. I'm talking of invest, I'm not talking of trading. Trading may think momentum. Here you think, when you invest, think of business model. And I think the first thing I look at when I invest in a company is the opportunity. Would I have invested in Titan if I didn't feel that the jewelry market in India will go, from 5% branded to say 20% branded? And in 5 years, if 1 lakh crore is going to be the branded market, is the jewelry market in India, the branded market will go up from 5,000 crores to 20,000 crores. So it's a 15,000 crore opportunity. So, nobody can grow bigger than the opportunity.
This is a very important lesson that tells that the mindset of an investor should be to look at stocks as businesses rather than mere pieces of paper that move in prices. And when you look at stocks as businesses, your investment decision will be based on the fundamentals of the business. And as he said, the business cannot grow bigger than the size of the opportunity itself. So if you invest in a company that operates in an industry with a large addressable market and a strong growth potential, the company will have a large opportunity to grow. With that said, let us listen to his next lesson.
What do you reckon is the most important ingredient for a young mind to start inculcating in her or him in order to be successful at this act?
First, they should love markets. They should be passionate about markets. They should have some idea of financial statements. They should have more wisdom and less intelligence. Remember, it's an act of wisdom, not an act of intelligence. Plus, you realize that, you're living in a future. The future is going to be uncertain. Right? So how you assess the future, right, is how well you will invest.
Here what he states is similar to what Professor Aswath Damodaran of New York University says. Investing is not just a science, but rather it is also an art. So investing is not merely financial formulas that will tell you right or wrong answer, but rather investing requires a wealth of wisdom from history to human psychology. Having curiosity about each and every field of business and human society will make you a great investor. That's all for this video, and if you find this video helpful, then show your support by liking and subscribing to the channel.